US banking in the spotlight. First Republic is rescued by JP Morgan after customers withdraw billions amid concerns over its future. And a seismic shift in the way that we work. Technology will radically change a quarter of all jobs around the world. But will it mean a surge in unemployment? Hello, a very warm welcome. This is World Business Report. I'm Ben Thompson. Now, we're going to keep an eye on those protests that are taking place right now in Paris. We're going to try and put those in a box so we can watch those throughout the programme. But we'll also look at some of our top business stories because there are developments in the world of banking. First Republic, of course, it's failed in the United States, but it has been rescued. And of course, there are still concerns about the wider banking industry overall. Another US bank has collapsed, and that, of course, causing shockwaves around the world. First Republic will be, though, taken over by the country's biggest lender, JP Morgan, in a deal orchestrated by regulators. Now, it has been under pressure for weeks as customers withdrew their cash over worries for its future amid a rapid increase in interest rates. Well, all of this coming just weeks after the collapse of Silicon Valley Bank in the United States and also Signature Bank. So let's explain what's happened. Well, over the last year, First Republic has seen the deposits that it held fell sharply by more than $100 billion. That's after customers lost confidence in the bank. Today's rescue deal means that JP Morgan will take over $203 billion worth of loans and other securities from First Republic. Well, amid concerns about the wider health of the banking system, JP Morgan's boss, Jamie Dimon, has said that this has helped stabilise the system, which, in his words, are a good thing. So let's speak first of all to Samira Hussain, who's in New York for us. And Samira, just bring us up to date, because just when we thought the spotlight had shifted from banking after the collapse of Silicon Valley, another in the spotlight and a last-minute rescue deal.
Last on Friday, I think there were a lot of conversations happening whether or not you would see that the government would step in to try and save First Republic. Remember, since the beginning of this year, shares in the bank have dropped by 95%. And a big part of those drops happened when it was revealed that over the last 3 months, we saw that more than $100 billion was taken out of the bank as customers got really worried about the solvency of this bank. So over the weekend, there's been a lot of conversations between government officials and with big banks to try and find a deal or find a way to try and save First Republic. And it is being reported that, in fact, what we heard from the FDIC and the Federal Insurance Board, they said, well, look, if you want to take First Republic, then why don't you submit your proposal to make that happen? 3 different banks submitted proposals, and in the end, it was JP Morgan that ended up buying all those banks.
Yeah, and what's interesting, Samira, we've been getting insight into how this deal was done, as you've touched on. We heard from Jamie Dimon saying it was an all-nighter. People were thrashing out this deal. They had, as you said, had to submit the details of what they were proposing. But he also says, look, this is a good thing. It helps stabilise the system, and it is not like what happened in 2008. And that's the thing that many people will be worried about, whether this is a rerun of that banking collapse of 2008.
Remember what happened, just 2 months ago or a month and a half ago with those other 2 banks when they failed. Everyone was asking that exact question. Are we going back to another financial crisis? Is this going to be reminiscent of 2008? And we saw government officials from all sides trying to reassure the public that, look, this is not the financial crisis all over again. Janet Yellen, Treasury Secretary, made those statements. We also heard from Jerome Powell, who also said the same thing, that this is a different case. Now, Jamie Dimon, in speaking to reporters earlier today, has even said, well, look, this is it. Now, the sort of the banking crisis that has taken over the United States over the last several months, this takeover of First Republic, that should really stop any of these other crises that we've been seeing in the banking system.
Samira, for now, I know you're going to follow this and the fallout of this for us throughout the day, but for now, thank you, Samira Hussain, there live in New York. Now, as promised, I just want to take you back to events in Paris. We've been following those scenes of pretty violent protests across the capital. Of course, this all related to President Macron's pension reforms, pushing that pension age from 62 to 64. Now, that deal passing through Parliament, but not stopping protesters. They've called the unions in France calling for an all-out walk. They are a protest. They're expecting or calling for more than 1 million people on the streets of Paris. Over the last hour, we've been following this activity. You see police there with tear gas taking on the protesters in many of the major cities. These are scenes in Paris, but we're told also similar events taking place in Nantes and other major cities across the country. We're going to follow those events and we'll dip into those pictures if there are further developments. But I want to get back on track with business too, because let's talk about that banking crisis. Samira was bringing us up to date with the latest on the collapse of First Republic and its last-minute bailout from JP Morgan. We can now speak to David Chiavarini, who is the managing director at the US investment firm Wedbush Securities. Thank you for being with us. And Samira was telling us there that there is now renewed scrutiny of the banking sector, particularly in the United States. I wonder, first of all, what you make of what we've seen over the past 24 hours. Another big banking collapse, but a last-minute rescue. Should we be breathing a sigh of relief right now?
Well, yeah, I would say so, in that now we have resolution on the highest profile bank that's been teetering since Silicon Valley Bank went under and Signature Bank went under. So I think it is time to take, kind of a deep breath with all of this. And I would agree that this is not like the 2008, 2009 financial crisis. What's different this go around is that it's not credit quality that's bringing these banks down. It's been the interest rate risk. And now that the Fed has put in place this bank term funding program in which banks can pledge assets, their securities, at par, even though those securities have lost value, that should stabilize the system. And then when we do a screen of which ones were most vulnerable, First Republic was near the top of the list, as well as Silicon Valley Bank, Silvergate Capital, which also went under, and Signature Bank had a high level of uninsured deposits. So I do think at least the near-term acute stress in the system is behind us. Now, that's not to say that looking out 12 to 18 months that we're completely out of the woods, because credit quality is likely to get worse for the banks, particularly in commercial real estate and office. So looking out further, we could see some, downside in the banks as we get through that credit quality issue.
Yes, and you'll forgive me and many viewers for thinking we've heard this before. The worst is over. There's nothing yet to see. But, given what you've said could be coming down the line, who else is vulnerable?
Who seems more vulnerable? I would say that the banks that are more vulnerable now are the ones that they're smaller, and they're ones that previously were screening poorly on an uninsured deposit basis, as well as a fair value mark basis. So a company called PacWest, CVB Financial, they were screening poorly, but post the results that they've put out for the first quarter, they've increased. PacWest has increased their uninsured deposits, or I should say their uninsured deposits have come down and their insured deposits have gone up to 73%. So that's up from in the mid 40s at December 31st. So they're shoring up their deposit base, which should lead to and mitigate the chance of a bank run here. So a couple smaller banks that haven't really been in the limelight that could face some issues, but for the most part, most banks should be okay from now.
And given what we're seeing in terms of interest rates, many of these problems caused, of course, by the central bank raising interest rates, and that's led to the current situation. The bank telling us that he thinks maybe we're at peak interest rates, particularly in the United States. Does that mean the problem starts to go away?
Well, I would say the acute stress goes away because you're absolutely right. The higher interest rates is what caused the value of these securities to come down, the value of their loans to come down. And now that we're getting towards the end of this rate hiking campaign, we should see some, less stress on the system. But with that said, the Fed is raising rates for a purpose. They want to bring inflation down. And to bring inflation down, that might lead to higher unemployment and higher credit costs down the road. But in the near term, I would think that the risk on the interest rate side should be mitigated now that we're nearing peak interest rates.
David, it's really good to get your thoughts. Thank you for being with us on World Business Report. David Chiavarini there, the Managing Director at the US investment firm Wedbush Securities. Now, speaking of jobs, nearly a quarter of all jobs around the world will change over the next 5 years. That's as technology continues to change the way we work, all according to the World Economic Forum. In their Future of Jobs report that's been published today, the organisation says the adoption of technology and increased digital access will cause significant labour market change. But despite worries, they say it will deliver a net positive gain in jobs. Well, let's speak now to Sadia Zahidi, who is Managing Director of the World Economic Forum. Thank you for being with us. And in some respects, no great surprise. We know technology is changing just about everything. But from a jobs point of view, there is a lot of concern that technology will take jobs. Your report says that's not the case.
So I think if we look at the last few years, there's been this concern about the robot revolution, about industrial robots and about humanoid robots that are going to take over jobs in factories and in healthcare and in education. And that hasn't played out. In fact, there has been growth due to technology. I think we're at a similar inflection point today when it comes to artificial intelligence. Yes, it's true that tasks that used to be primarily the purview of humans, communicating, coordinating, reasoning, those things are more automatable today because of artificial intelligence. But at the same time, there's a lot of growth in adjacent roles and an opportunity for humans to bring much more value add to these roles. So there are certainly risks and there certainly will be job losses, but there's also going to be a huge opportunity for growth.
And you touched on some sectors there where it will make the biggest difference. I wonder which are most vulnerable to change.
So some of the roles that are most vulnerable, bank tellers, postal service workers, people who are working in administrative roles and secretarial roles, those are really the roles where the most disruption is possible. And the highest growth is going to be around artificial intelligence, machine learning, people who are doing data analysis and data specialists. Those are really going to be the growing roles of the future. But when it comes to the highest number of jobs being created, education, agriculture, healthcare, sustainability, and green energy. That's where the largest numbers of jobs will be created.
Sadia, it's really good to get your thoughts. There's a lot to fit in this hour, so sorry to keep it brief, but Sadia Zahidi there, Managing Director of the World Economic Forum. Thank you. And let's just show you those scenes live in Paris. So we've been following events there and right across France as those pension protests once again take place in protest at raising the pension age from 62 to 64. Continuing coverage here on BBC News.